So Meta drops a staggering $27 billion on this massive AI computing deal with a company called ABS on Monday.
Right, a totally historic bet,
Yeah.
like massive.
But then by Tuesday, I mean, barely 20 hours later, NEBIOS's stock crashes over 9%.
Yeah.
Like, how does a market go from absolute euphoria to utter panic in less than a day?
Yeah, that is exactly the illusion we're tearing down today. Because, we really need to look past all that Monday hype and analyze the real, brutal business logic behind this sudden reversal.
Because on Monday, the narrative was just intoxicating. I mean, everyone was shouting that AI demand is exploding, we don't have enough GPUs, and, NEBS is the next NVIDIA.
Right, but that narrative relies on just a complete misunderstanding of the contract itself. Like, you really need to take a second to look at the actual math here.
Yeah.
Because $27 billion is an order, not cash.
Wait, not cash.
Exactly. And it's future money.
So Meta didn't just, wire them billions of dollars on Monday, because I'm pretty sure a lot of people just assumed NEBS was suddenly sitting on a literal mountain of cash.
Oh, no. Far from it. When you actually read the filing, only $12 billion is a locked-in exclusive computing contract.
Okay, so what's the rest?
Well, the other $15 billion is purely conditional. So Meta is essentially offloading all their massive financial risk onto the supplier. They're basically saying, if you build the perfect data center, well, we might rent it.
Hold on, are you saying NEBS has to spend their own money to build this massive infrastructure before they even see a dime of that $15 billion?
Yes. Which brings us perfectly to Tuesday's massive reality check. I mean, NEB has announced a $3.75 billion convertible bond offering, literally just to afford the land and the GPUs required to fulfill Meta's order.
A convertible bond. Why wouldn't they just take out a regular bank loan if they have, a huge client like Meta lined up?
Well, because they were actively losing money right now. They likely couldn't even afford the standard interest rates on a multi-billion-dollar loan.
Oh, wow, okay.
So instead, they issue debt that can convert into stock down the line.
I see. But wait, how does a bond deal end up triggering a massive stock crash on Tuesday?
Well, think about it. When that debt eventually converts into new stock, it floods the market with new shares,
Yeah.
right?
Right, basic supply and demand.
Exactly. That dilutes the value of everyone else's slice of the pie. So they are forcing dilution onto their current investors before Meta even pays them a single cent.
Man, it's like landing this massive catering contract for a royal wedding, but then realizing you have to go buy the land and build the commercial kitchen out of your own pocket before you even cook a single meal.
That is a perfect analogy. And in the AI catering business, a single oven costs billions of dollars.
Right.
People just keep treating this like it's a light asset software play, like you're just writing code in a garage somewhere. But here is the core truth. Listen, AI is more like heady industry.
Heavy industry, like factories and stuff.
Yeah, you aren't just writing code anymore. You are pouring steel. You're laying fiber optics across oceans. And you're building literal power plants.
Wow. Okay, so since they have to borrow billions just to fulfill a quote-unquote maybe contract, how does the rest of the industry plan to afford this? I mean, Meta, Microsoft, Alphabet, they're all in this global race.
It is basically an all-out capital war at this point. And remember, NEBS is currently trading at 57 times their sales.
Wait, put that in perspective for me. Is 57 times sales really that insane?
Oh, absolutely. To give you an idea, a healthy, established tech company might trade at, say, 5 to 10 times sales.
Oh, wow.
Yeah, at 57, the market is prepaying for this massive, totally unproven growth story. And in heavy industry, the faster you grow, the more cash you just burn through.
So everyone is just burning cash to build these massive data centers on the pure assumption that the growth never, ever stops. Which really makes you wonder, who is going to pay for this infrastructure?
That right there is the multi-billion-dollar question. Honestly, Tuesday was simply the brutal math catching up to Monday's fairy tale story. The market finally looked at the actual price tag of this revolution.
So what does this mean for you listening right now?
Well, if we connect this to the much bigger picture, the reality is the biggest risk in AI isn't lack of demand, but rather it's too expensive.
Too expensive. So expensive that even insane hypergrowth might not be enough to actually sustain it. So what do you all think? Is it A, AI just keeps exploding, B, we've got some short-term turbulence ahead, or C, this is the very beginning of a massive bubble?
And just a quick reminder, this deep dive represents a personal analysis of business logic and does not constitute investment advice. Markets are risky, please conduct independent research before making decisions.
Absolutely. So next time you see a flashy headline about a massive AI deal, just take a second, stop, and ask yourself, who is actually buying the food and who is just taking out a desperate loan to build the kitchen?